Second leg of our process, our framework, investing framework, is the behavioral part. So this is in the context of the current markets, we have tried to put some biases that we also suffer from, and generally we hear in the market based on our conversation with people, like friends, family members, investors. So this is something that is quite pertinent in the current times, and we do it in a proper framework, in a very well documented form. So we are able to avoid these biases. So basically, cognitive biases are biases which prevent us from taking the right decision. Basically, we get emotional about our decision making process and end up making mistakes. So think about the current times. So after this fall, the valuations have become interesting. Even then, someone who had planned to invest at some point in time, he's just stepping back. Why? Loss aversion. If you see on the top on the left hand side. So loss aversion is a bias that humans are wired to suffer from. Basically, we all like profits much more. We all hate losses much more than we like profits. So, for example, if someone tells me about a bet wherein I can have a profit of 100 rupees and I can have a loss of 100 rupees, I'll never take whatever be the probabilities of profit versus loss. Basically, I dislike a 100 rupees loss 2 times more than I like a 100 rupees profit. So in the current context, what is happening is, let's say an investor thinks that 3 years from now, the market will give me 50%, right? 100 rupees will become 150 in 3 years from now. But he is suspecting that the market can go down further 5% if he were to invest today. So because of that fear of that 5% notional short-lived loss, he will not go for that potential up move of 50 rupees. So he's holding on. So this is the kind of bias that holds us back, and at least we have tried to overcome these kind of biases. Similarly, overconfidence. This is another bias that afflicts almost everyone. What? So right now, many people are thinking that no, I want to wait. I want to wait for the market to come down further, because I know when essentially this is based on the belief that when it comes down further, I'll be able to catch that bottom. Now people are forgetting that this is absolutely impossible. I mean, you can ride your luck once in a while, it is possible, but there is no framework to determine the tops and bottoms. Because think about it. I mean, it's called a base rate in psychology. That had it been so easy, no, everyone would be doing it, and everyone would be making a lot of money while people work, while people go to offices. Because it's very simple. Investing should be like buying at the bottom, selling at the top. Very simple. But this is what is the most difficult part in investing. So that's why we have to accept something that is not, that this thing is not doable, this thing is not forecastable. So we should keep, we should acknowledge our limitation. So this is what overconfidence bias does. Then there is another thing that is scaring us right now. People are really, just about 2 weeks back, people were really scared. People were taking out money. Some people were just had stopped in the ranks, not doing anything at all. What? Recency bias prompts us to think that whatever is happening right now, that's the worst phase of my life. I have never seen worse. So I heard it from a very well-experienced investor. He was saying that I have never seen this kind of a market. Then I reminded him that it's just 2.5 years ago we had seen that. You also were there, right? 2022-23. It was, in fact, it lasted for 9 months. It was longer than what has happened so far. So, and before that also, as we saw earlier in the presentation, that this happens quite regularly. Or think about it from a geopolitical perspective. About 2 years ago, people were really concerned that this is the first time after the Second World War that a nuclear-armed country is involved in a full-blown war. So people were saying anything can happen. But look, I mean, 3 years have passed by, and nothing has happened. No nuclear bomb has been dropped. So see, the thing is, we have to appreciate that markets have to cross a wall of worries at any point in time. There are very few periods where there are no concerns. Something or the other will be there. And when there are no concerns, then we should be scared, because that is the period when bubbles get created. So when there are concerns, actually it's a very good sign that people would not get carried away. There would not be too much of froth in the market. Then one more I'll talk about is getting anchored to wrong figures. So for example, there's a very good stock in our portfolio. One person wanted to talk about that. I told him, why do I like it? But he said that no, I'm not convinced. Why? Because it has fallen only 9% from the peak, from its September peak. So I want to buy stocks which have fallen 30, 40, 50%. Now, this is a big cognitive bias that prevents people from making money in the markets. Why? Because you are comparing it to a wrong context. So we should not be comparing it to what the 52-week high was or what the 52-week low was. The context should be that this stock right now is at 100 rupees. It fell down from 110, but it is worth 250. So in next 4 years, probably it'll go up to 250. I should be comparing it to 250. I should be saying that it's available at its discount of 60%. The upside is 150% from here, instead of thinking that it has fallen only 9% from the peak. So these are the kind of things that matter. One more thing, authority bias. So many people are taking a call on the basis of what they watch on business news channels, or maybe what influencers are saying. So basically what happens is that just because that person is on TV or he's having such a big fan following, so we think that, okay, he must be knowing something. He must be having that authority. So he can get away with whatever. So whenever he says that, no, 31 days from now, the market bottom will happen, so I'll wait for 31 days. So these are the kind of issues that crop up, and we try to avoid. At Magad Capital PMS, we try to avoid most of the biases that are very common. Think about portfolio decline. See, the way to look at it is that decline in portfolio is not equal to a decline in wealth, as long as I become jittery and book the losses. So these declines are temporary, they are notional, they are short-term. So eventually they come back. Only thing is, one must be sure that the kind of stocks that are there in the portfolio, they have to be impeccable. And especially the portfolio, the entire portfolio, the kind of diversification that I've imparted to the portfolio. So finally, this is sort of bottom line for, at least in one perspective, that market timing is not possible. So why should try doing that? Had I been able to do that, it would have been good, right? It would have brought me to perfection, but it's not possible. So it's futile. Let's try to do something that is equally potent in terms of long-term wealth creation potential.